for joining our ASA Stats with Marketing online workshop. Today we have Dan McCarthy talk about customer-based corporate valuation. Dan is going to be an assistant professor of marketing at Emory University starting this fall 2017. He got his Ph.D. in statistics from Wharton School of the University of Pennsylvania, and he's also co-founder and chief statistician of Zodiac. It's a predictive analytics firm. His research interests are around customer lifetime value, Bayesian computation, the marketing finance interface, customer-based corporate valuation, and digital marketing analytics. Well, just some housekeeping before we get started. You can send your question through live chat function from YouTube, or you can send your question to this email address. For our workshop information, you can go to scientistcafe.com, and we will upload the slides later. Okay, now I will turn to Dan.
All right, great. So thank you very much for having me. And hopefully, let me just make sure that everyone can see my screen. All right.
I should stop sharing now.
Okay, so now hopefully, can everyone, is it possible to see my screen now?
Perfect.
All right, perfect. So yep, today I'm very excited to share with you work that's been ongoing really over the past 2 years on what we call customer-based corporate valuation. And this is really kind of taking a bottoms-up view of the overall valuation of a firm by decomposing that value into kind of all the little, the incremental value that's being generated by each and every customer that a company currently has, and those that we expect to have in the future. So I'll kind of go into all the details over the course of the rest of this presentation, but hopefully this will give you a pretty good sense for how we can do customer-based corporate valuation across a variety of settings and really bring it to life with a handful of examples with real companies. So if you were to open up a standard corporate valuation textbook, it would typically decompose the value of a firm into 3 main pieces: the operating assets, the non-operating assets, and the net debt. And of these 3, 2 are relatively straightforward to estimate the value of. The net debt is simply taking all the company's outstanding debt obligations and subtracting off their cash and cash equivalents. The non-operating assets are also relatively straightforward. This is basically anything where if we were to literally light a stick of dynamite and just blow it up, it would have no effect on the firm's ability to generate revenues and how those revenues will flow through into profits. So examples of this would be excess real estate, any other non-operating assets that the firm might have. The really tricky and the really important one are the values of the operating assets. So this is basically everything that drives the firm's ability to generate revenues and how the firm is able to turn those revenues into actual cash flows. And so it's going to be driven by all sorts of factors, including distribution relationships, the effectiveness of the sales operations, any technology or IP protection that the firm might have, and so on and so forth. And as a customer-based corporate valuation advocate, the fundamental and hopefully relatively humble claim that I would make is that underlying every single dollar of revenues that a company generates is a customer. And so if you gave me the right kind of summary customer data, and I was to intelligently kind of incorporate that data through a model, I can come up with more accurate estimates of what the operating assets will be worth by making better predictions of what future sales are going to be. And that's really kind of the essence of this work. Now, the exact model that I'm going to use to incorporate yes?
Yeah. Could you do full screen? Now the screen is relatively small. It just, can you do full screen?
Yeah, let me, this should be full screen. I'm not sure.
Right now there are a couple, like there's some, on the right side, there's the next slide. So
I see what you mean. Yeah, let me, let me just share my other screen then. Okay. So here we go. And then there.
Yep.
Is it full screen? All right, great. Yeah, so as I was saying, so that's the underlying kind of the meta framework is what we see right over here on this slide. You know, that basically we want a model for the customers, and we're going to use that to come up with more accurate estimates of what the operating assets can be worth by really making more intelligent and accurate revenue forecasts. But the actual model that we're going to use really depends on kind of two main factors. The first is, what is the business that I'm analyzing? And the second is, what is the sort of data that I could assume that I have the ability to see? So the main distinction that I would make between when it comes to the sort of business that I'm analyzing is, am I thinking about a subscription business or am I thinking about a non-subscription business? So subscription business or a contractual business is one where essentially I have the ability to observe when customers churn. Non-subscription or non-contractual businesses is essentially everything else. And as I'm going to show kind of later on in this presentation, it's the non-subscription setting that's typically the more difficult of the two. The second dimension is the sort of data that we have access to. Now, typically, performing very detailed analyses is much easier to do when I have access to internal data. And it's typically much harder to do when I only have access to external, typically very aggregated data. So I'm going to kind of unbundle both of these dimensions in the next few slides. So again, the first dimension is what sort of business we're analyzing. If it's a subscription business, the problem is much easier. Basically, because I have the ability to observe when customers churn, I'll always know how many customers the firm has active over time. So examples of subscription businesses would be telecommunications firms or gym memberships or software as a service companies. And in each of these cases, if I wanted to churn, I would really need to kind of raise my hand and let the firm know. But even if we were to kind of hold aside customers being alive or not, just the stream of payments that I get from customers over time tends to be more regular and well-behaved at subscription businesses. So think a magazine subscription or say Netflix. There's typically kind of a very simple monthly fee while the customers are alive. Maybe that steps up at the end of the year. But in general, it's much more kind of well-behaved than what we would see at non-subscription businesses. So at non-subscription businesses, we really have kind of three main challenges. The first is we don't get to observe when customers churn. If I kind of soured on J.Crew as a brand, I'm just going to simply stop making purchases. I don't need to tear up a contract or anything like that. But even holding aside customers being alive, the number of purchases that I make over time and the amount of spend associated with each purchase is going to be a lot more variable typically, both within the same customer over time, say the difference between the holiday season and off-peak, and across customers. That some customers might be big spenders, others might be big purchasers, and we would want to be able to account for those differences if we can. So in general, this is a much harder problem to crack, but there's actually models that do a very good job of being able to model and forecast non-subscription customer behavior. The difficulty is typically these models assume that we have access to internal company data, which is a segue into the data that we have available. So again, as I was saying, if we have access to internal company transaction logs, John Smith, purchased $52.21 on August the 1st. That's the sort of information that I wish we would have access to. But typically, if I'm performing a valuation analysis, the analyst is almost always going to only have kind of rolled up summaries of that sort of data. So instead of knowing that John Smith, made a purchase for $50.21, I might get total revenues in a quarter. So it's kind of marginalizing across the customers within these quarterly strips of time. And it makes it that much more difficult because I'm having to infer all of that rich individual level behavior, but I'm only getting to look at these kind of very summary metrics. So that makes it harder as well. So imagine I had a model for the customer, based on that 2x2. What I'm going to do is I'm going to insert that into kind of the de facto standard valuation model within finance. It's called the discounted cash flow valuation model. This is the model where if you were to go to your iBanking friend and ask him to pull up the most recent spreadsheet that he has on a company that he's covering, he or she, it's probably going to have a DCF model in it. So rather than kind of supplant kind of the model that finance people use day in and day out, I'm going to just use their model and show that we can augment it and make it that much more accurate by incorporating this customer model. And I'm going to show how when I move to the first case study, which is Dish Network. So Dish Network, they're kind of one of the two main companies that I had done an empirical analysis on in my first paper. The link is available here. And again, as we had said, this presentation deck will be made available if you'd like it, so you don't need to write anything down. But Dish Network is a pay TV services business. So people will pay a monthly fee. In exchange, they get access to a whole bunch of TV channels that they can watch. So this would be an example of a subscription business where I get to observe aggregate data because it's a public company, and I'm only going to do my estimation on data that Dish has made available through its quarterly and annual filings. So, kind of going to that 2x2 matrix, this is contractual with external data. This is the actual data set. So as I was mentioning on that previous slide, I'm only using data that Dish has made available publicly. And so what we see here are kind of quarter by quarter from the beginning of commercial operations. The only data that I'm using is customers acquired each quarter, the number of customers lost each quarter, and as a result, the total number of customers that Dish ended each period with. So we have that over all the quarters through the first quarter of 2015. That was the last quarter when we were writing our Journal of Marketing paper. And we see kind of in some of those early periods that we don't have all of the information. So there's some periods that we have, which we would call left censored. So we're going to take that model and we're going to have to build a model for it. So the overall framework that I'm going to use to model and forecast customers into the future is this, what we call the customer triangle. It's this triangle that we see within the blue box over here. The rows represent time. Here it's months because customers have the opportunity to churn every month. And the columns represent acquisition cohorts. So as I move down the diagonal of this matrix, this is basically the total number of customers acquired month by month into the future. So for example, we see 1.29 million customers were acquired in February. Now, after I've acquired a set of users, they're going to stay with me for some period of time before they churn. So we see here, for example, by June of 2016, 1.19 million of the original 1.29 million customers I acquired in February are still active within that particular acquisition cohort. And if someone gave me a crystal ball with which I could basically forecast what future acquisitions are going to be, and then forecast the retention of those customers once I've acquired them, mathematically that has to give me the total number of customers that are active at the end of each period for free. Because the total number of customers has to be equal to the sum of all of the active customers across all the preceding acquisition cohorts. And that's what I'm indicating here within this green box. So I'm going to specify what I call a hazard model for the acquisition of users into the future. That essentially, when commercial operations for Dish begins, it's as if there's a very large number of prospects, and they all have stopwatches in their hand. And once commercial operations starts, they all press that stopwatch, and there's going to be some amount of time that elapses until they're converted into acquired customers. And so this is a timing model. The timing model that I specified is a very standard one within the actuarial sciences. The hazard model is called the Weibull gamma model. Again, it's a very standard and very effective model that's been used in other contexts as well. Now, once I've acquired a user, they're going to stay with me for another period of time before they churn. So again, it's another timing process where it's like they're pressing a second stopwatch once they've been acquired. So I'm going to use exactly the same hazard model, the Weibull gamma, for the retention of users once they've been acquired. So that's kind of a high-level overview of how the model flows. This is going to get me what I would expect total customers to be. And once I kind of layer on a process for the average amount of revenues that I'm going to get per user, that's going to get me to total revenues. And this is exactly where a typical DCF model starts. The DCF model shows how you go from revenues and convert those revenues into free cash flows. And all I'm saying here is revenues are extremely important, but let's just do a little of this machinery on the back end to come up with more accurate revenue forecasts. So that's kind of a high-level overview of the model. So we're going to estimate this model off of the observed acquisition, loss, and ending customer count data, quarter by quarter, which is very easily derived from this matrix by simply summing up every 3 elements on the diagonal. That's going to get you quarterly acquisitions. And we get the ending customer count information by looking at this total customers column and just picking off every 3rd element. So pretty straightforward. So we run the model, and we get we basically want to see how good of a job we're doing at predicting the future. Because again, that's all a DCF model is trying to do, is come up with accurate projections of future revenues and future cash flows. So the way that one way I wanted to validate the model was to say, imagine I took all the data up to every possible calibration period. So those are indicated by these blue dots over here. And I'm going to validate acquisitions, I'm going to validate quarterly losses, I'm going to validate the ending customer counts each quarter. So that's the top, the middle, and the bottom panels. I'm going to train on all the data up to those blue dots, and then I'm going to predict, based on that data, what I would expect to happen over the ensuing 2 years. So those predictions are the wispy blue lines that we see over here. And we can see that in each of these cases, we're doing a very commendable job at forecasting really adds, losses, and ending customers, even with a relatively small amount of data. So this gives us a good feeling that our model is relatively well calibrated. Another gut check is just coming up with the valuation estimate. So what we see here is just the summary valuation table from the Journal of Marketing paper. We made assumptions about the margins and about cash flow adjustments. And that's what gets us to a stock price that was within just 3% of the then current stock price. So very, very, very close. We made all of the assumptions available in our paper in perfect detail so that you could easily replicate our results if you wanted to. But we've presented this work to a whole bunch of finance professionals, and we've got no pushback about the assumptions that we made. But the final validation, just to make sure that we're extra comfortable with the model that we're using, is to compare our predictions to other people who are making revenue forecasts. So who else makes revenue forecasts? Wall Street analysts do. Every quarter, they're going to come up with predictions of sales and predictions of earnings per share. Those are the 2 main things that they'll typically forecast. So we basically said, let's take every single one of the predictions that are made by these analysts, all 3,500 of them, over this period from 2001 to the end of 2014, and just see how our predictive accuracy compares to theirs. How do our forecasts compare to the ones that they had made, and are we more accurate than them? So just to kind of give a sense for the underlying data, I'm going to pull just one row from that data matrix for the analysts. So this is an actual analyst forecast. So on July 28th, 2005, there's an analyst who makes the forecast. They predict that Q3 2005 sales are going to be $2.1 billion. So what's the forecast that we would have made? Our model, again, is only being estimated off of quarterly and annual reports. So the most recent quarterly report was actually 2.5 months prior, on May 5th, when the company released Q1 2005 results. And based on those figures, we would have predicted that Dish generates about $2 billion of sales. So kind of fast forward to Q3, Lo and behold, the company actually earns almost exactly the same amount of revenues as what we had forecast. Obviously, this is a tremendously cherry-picked example, but if we were to kind of average across all 3,500 forecasts, our forecasts were about 10 to 15% more accurate than those of the analysts, very consistently. And we've run a number of robustness checks, both in terms of the error metric that we used and in terms of the period that's being analyzed. And the gains held up. So again, we feel very good about our ability to validate our revenue projections and that this model is actually adding incremental value. But wait, there's more. So fast forward to today. Again, that model we had run, we had data up until Q1 of 2015. So one exercise that we thought would be very informative for the students of Professor Pete Fader's course, he's one of the co-authors on the paper, in his marketing models course, was to have his students predict customer acquisitions using hazard models almost identical to the ones that we used in our paper. But we had them basically do their analysis, assuming they have access to all of the data. So at the time that they did their final project, they had data up through and including Q4 of 2016. So this is the actual full data set for customer acquisitions. And these are the resulting forecasts the students made. The red lines represent each individual forecast. The solid blue line represents the average of those forecasts. And the dotted blue line represents the 25th and 75th percentiles of that distribution, quarter by quarter. So let's zoom in just a little bit, just to make it a bit easier to see. And one of the things that I wanted to test was to say, how calibrated were the students? And so one of the ways I did it was waited a little bit, and then Dish Network reported Q1 results. And so I said, let's compare the students' forecasts to those of the Wall Street analysts once again. And as it turns out, the students trounced the analysts once again. The average prediction for Q1 2015 was just 0.5% off from what we actually observed. And it's just another way of thinking about it. The median of the undergrads was perfect. There was actually zero error. In contrast, the Wall Street analysts, on average, over-forecasted Q1 acquisitions by 13%, a very, very large number. So this was just, it was so striking to me that I decided to write something about it. So I wrote up a little note, and it ended up getting published in Dow Jones Market Watch. So it got some well-deserved brownie points for the great job that the students had done. So it'll be very interesting to see. Q2 2017 is rolling right around the corner, and we have our estimate of basically what we think will happen. We think that while the analysts were quite optimistic, over-optimistic in Q1, I think that they're overly pessimistic in Q2, but time will tell.
So the student use your model, or the student use other way to estimate?
They only used hazard models. What was
Okay.
creating the variance over here was that they made different assumptions about exactly how they implemented the hazard model. So yeah, you're exactly right. This isn't exactly our model, but it's essentially using the same machinery. And actually, I think almost all the students use some form of Weibull gamma.
Okay, interesting.
Yeah, so I thought that was just a great exercise, and very nice to see. Just the power of kind of thinking about these numbers scientifically, as opposed to, I think, the typical thing that an analyst will do, which is to kind of gut check it. Second case study, Blue Apron. So on June the 1st, Blue Apron, so first, just as kind of a little background, Blue Apron is a meal delivery kit service business. So essentially, you pay kind of a monthly fee, and they send you meal kits. So it's just a whole bunch of ingredients, and you cook the meal yourself. And so really what it's supposed to do is take some of the burden off of deciding what meal to make on a particular day. And the business has, it's been growing tremendously. And on June the 1st, they filed the Form S1 to state their intention for their upcoming IPO to go public as a company. And so someone had asked me, Dan, is there anything interesting that you can kind of glean from the S1? So I went in and took a look. And what was amazing to me was that there were no churn metrics at all disclosed in the S1. And just kind of going back to that dish example, I'm so tuned to expect metrics like that. But what was interesting was they did disclose a number of other data points. So they disclosed the total number of orders period by period, the total number of active customers, which is akin to those ending customer count data points that we saw for Dish, marketing expenditures period by period, which is typically a pretty boring number. But they also gave us what they called the customer acquisition cost, which is essentially total marketing expenditures divided by the total number of gross customers acquired. And so that, in conjunction with the marketing expenditures, gave us total customers acquired. And then they gave us a whole bunch of other kind of cumulative revenue information that I'm not going to kind of dive too deeply in here. But suffice it to say, the combination of this data was enough for us to be able to run almost the exact same model that I had run with Dish, and also for SiriusXM, the two examples from the Journal of Marketing paper. So I wrote a series of a couple of notes. The first one was on June the 2nd, and then the second one was just a few weeks later. And one of the first things that I always do is make sure the model validates well. So over here, these are just kind of a handful of validation plots showing what we expect: active customers, cumulative customers acquired, cumulative revenue per acquired customer over various amounts of time, and total orders to be. The blue bars represent what we expected. The orange bars represent the actual data from that S1 filing. And kind of as with Dish, we see excellent correspondence between these two with a relatively simple model. So the real upshot was, okay, what is this model telling us about the unit economics of Blue Apron? So again, they didn't disclose any churn metrics. But with this model, one of the things that comes for free is the retention curve. That is, what is the proportion of customers that are still alive as a function of the number of months since the customers were acquired. And what we can see here is that their retention, they have a retention issue. So one of the numbers that I was highlighting in the notes was just 6 months later, 6 months after the customers have been acquired, only 28% of them are still alive. So fully 72% would have churned just 6 months after acquisition. And that's really quite poor. Contrast that 72% number to a firm like Dollar Shave Club or Netflix. They have 6-month churn of, say, between 30 and 40%. So, just kind of much lower. But the other thing that we could see is the cost per acquired customer has been growing very rapidly. So on that previous slide, I'd showed kind of the average customer acquisition cost from Q1 of 2014 to Q1 of 2017, and that number was $92. But what we can see more recently is that Blue Apron's been spending on the order of $145 to acquire new customers now. So it's just, they're having to spend more to acquire them, and the customers are churning out pretty quickly. Both of those don't bode too well. So what was the media's reaction? Well, it seemed that the media was really quite interested. I've never had a post go viral before, but these posts went viral. There were a couple of Wall Street Journal articles. This was featured in Fortune's Term Sheet by Aaron Griffith, and about a dozen other media outlets, including a few pieces in the Business Insider, Slate, Barron's, and so on and so forth. So it really seemed in this case, and I think in general, that the investment community is quite interested in these kind of traditionally marketing-focused figures. So I thought, again, just very great to see interest from the financial community and something that's really just been in the domain of marketing academics. The stock market's reaction was also pretty striking. So originally, Blue Apron had priced their IPO at between $15 and $17 per share, a valuation of up to about $3 billion. But just a week later, after this post, and obviously the other big elephant in the room was Amazon stated their intention to acquire Whole Foods, and people are very concerned about the effect that that's going to have on competition from Amazon. They slashed their IPO price to between $10 and $11 per share, and this has only happened in something like 5% of IPOs. So it's something that typically doesn't happen. Their actual IPO was at the bottom end of that range, of $10 per share. And since then, the stock price has fallen an additional 26%. It had actually fallen about 35% as of Friday, but the stock popped again today. But still, this is definitely a very negative market reaction to an already fairly muted IPO price. So again, marketing metrics matter. The markets care about acquisition, retention, and ARPU. And I think it pays for firms to really focus a lot of their efforts on this. So that's basically the two case studies for subscription-based valuation. So I'm going to take a big pause. I'm going to move to the non-subscription setting and show that we can do basically the same sort of magic for a non-subscription firm that we could for subscription firms. So the running case study is going to be an e-commerce retailer. It's basically a big geographic region for that firm. They were very kind. They shared basically all of their granular data with us. We know that we're never going to typically have access to data like that with public companies. So I basically aggregated the data, and it allows us to validate on granular data and think about what are the most informative metrics. So in addition to kind of being able to kind of crank the machinery, given a certain set of data, I want to be able to make prescriptive guidance about what is the most informative data. What's the data that most reduces my uncertainty about what future kind of orders and sales are going to be. So very excited about this work. I'm actually almost done with the revision of this paper now, and I'm going to talk about some of the new features that are going to be in the next version. So again, going to that 2x2 matrix, non-subscription firm, assuming that we have access to external data. So I'm going to very quickly go through just some of the elements of the model. The acquisition process is exactly the same as the one that I had shown in the subscription paper. So I'm not even going to spend any time with that. Where this model starts to diverge from the subscription model is that here we actually have orders. So we have a repeat purchase process. And this model is essentially an extension of the Fader-Hardy, what he calls the beta geometric beta binomial model. And at a very simple level, this model basically posits the following individual level story. Once I've been acquired, every customer is going to be endowed with two main things. One is a baseline propensity to make purchases, and the other is a baseline propensity to churn or permanently end the relationship with the firm. In every period, it's as if I'm going to flip a coin. And if that coin comes up tails, I'm going to remain alive and have the opportunity to purchase. And that coin's probability is dictated by this theta that we see in the upper right-hand side of the slide. Assuming that I'm alive, that coin comes up tails, I've got the opportunity to make a purchase. And that purchase is going to be dictated by this piece of T that we see. And the probability of purchase is going to be driven primarily by a baseline propensity to make purchases, which is this B sub P term that we see in the upper right. And that's going to be kind of perturbed up or down on the basis of external covariates, so things like seasonality and the state of the macroeconomy. So I kind of repeat this sequential drill of flipping the death coin and then flipping the purchase coin until I flip that death coin and it comes up heads. Once it comes up heads, I've churned, I've ended my relationship with the firm. The probability of making a future purchase is 0. The other divergence between a non-subscription model and a subscription one is that now I have to model the spend per order as opposed to just modeling the spend per active user. So I embrace heterogeneity. I'm going to have some big spenders, and I'm going to have a lot of small spenders. So I'm going to allow for cross-sectional heterogeneity in spend per order through a log normal distribution. And the mean of that log normal can rise or fall on the basis of pricing power and or inflation. So this is a very simple 3-parameter model for spend per order. So that's the model. And a big question is going to be, what is the data? So again, because non-subscription firms are less far along in terms of maturity and customer-based analysis of this sort, there just aren't too many companies right now that actually disclose these metrics. In the next version of the paper, I've actually identified 2 publicly traded companies where we do have enough data to perform this analysis. But again, we almost want this to be kind of a policy paper. And so we want to be able to say, what should firms be disclosing? So kind of going process by process, I'm going to start with the 2 easy processes to kind of make that prescriptive guidance for. For the acquisition process, in the same way that our acquisition model is the same as the one that we use in the subscription-based valuation paper, I think the metrics should be the same as well. Just quarterly customers acquired, period by period, it's the most natural metric. It does a very good job of being able to identify the parameters of the acquisition model. Case closed. The spend process is also pretty straightforward. Because we're doing our analysis for publicly traded firms, we kind of get average spend per purchase for free, because the average amount that's spent on a purchase is essentially total spend divided by the total number of purchases. And public firms have to disclose total spend. That's total revenues. And because we have an acquisition and a purchase process, that gets us what we would expect total purchases to be. So the question is really, what's the most natural companion metric to the average spend per purchase? I'd be happy to consider other metrics. This methodology is robust to whatever metrics we want to feed it. But I think median spend is by far the best along kind of 2 main dimensions. First, it's very communicable. I could definitely see, say, the CEO of a firm disclosing median spend to the investment community over time. But also, the mean and the median do a very good job of being able to estimate the parameters of that log normal distribution that I showed on the previous slide. So again, happy to consider other metrics. Yeah.
Yeah, for this data, you have each time point, you have different purchase size, right? And it will be a time series across the time too.
Yes, that's right.
Okay, and you get the median for the purchase at each point of time.
Yeah, so you can basically think of it as I take all of the individual spend amounts across each of those purchases within a particular quarter, and I just kind of rank sort them all and then pull out that 50th percentile.
Isn't that distribution be very skewed? Based on my experience in the company, the purchasing data usually very skewed with long tail.
Oh, exactly. Yes, that's why, kind of backing up to this slide. We wanted to.
That's what I.
Oh, yeah. Well, so this is actually a log normal distribution for the expected spend per purchase for a particular customer. So you could imagine that the actual individual spends might be another log normal distribution. So it's almost like there's 2 levels of log normal distribution that are going on here. And that actually is very analogous to a model that Professor Pete Fader and Bruce Hardy used in a previous paper. They basically had a spend per purchase model called the gamma. And there you've got kind of a baseline propensity to purchase. It's dictated by 1 gamma distribution. And then you've got gamma draws from that, which dictate the amount of spend on a particular purchase. So totally agreed. This might not even have a finite first moment.
Okay, yeah. Thank you.
So I'm not even going to go into the estimation. I don't want to bore you, but essentially the main thing that we're going to do is we're going to posit this model, and we're going to essentially find the set of parameters where if we were to simulate data from those parameters, the expected data is the most consistent with what we would expect the metrics to be. But obviously, I haven't even kind of gone through the real difficult kind of process to think about the data for. The purchase process, I can't think of a very natural metric or set of metrics to really kind of pin down this one. So rather than kind of arbitrarily pick out a couple of metrics really from a hat, I basically said, let's take 6 common metrics of the sort that you'd find in a customer metrics textbook and just put them to the test and let the data tell us what the best combination of metrics are, if we even need multiple metrics. So the metrics that I'm going to focus on are active users, heavy active users, the repeat rate, the repeat bar proportion for orders, the repeat bar proportion for customers, and the average buyer purchase frequency. So rather than kind of bore you with words, I'm just going to use a very simple illustration to kind of get a sense for what each of these metrics are. So imagine that we had just 3 customers, and imagine that we're looking at data over a period of 3 years. So this this triangle over here represents the total number of transactions by year and by customer for each of these 3 customers. So for example, this is saying the second customer was acquired in year 2 and made 3 purchases in year 2, and then another 3 purchases in year 3, and so on and so forth. So let's think about the metrics. So gross customers acquired in years 1, 2, and 3 would be 1, 1, and 1, because we acquired customer 1 in year 1, customer 2 in year 2, and customer 3 in year 3. So 1, 1, and 1. What would be the number of active users? Basically, the definition of an active user is someone who has made an order at some point over the preceding year. So in year 1, we just had 1 active user. In year 2, we see we have 2 active users. And in year 3, again, we only have 2 active users because customer 1 did not make a purchase in the 3rd year. So 1, 2, and 2. Heavy active users is the number of customers who make 2 or more purchases within a particular year. So we see no one made 2 or more purchases in year 1, but we had 1 customer in both years 2 and 3 who made more than 1 purchase. So it's 0, 1, and 1. The repeat rate is a very common metric that you often see in metrics textbooks. And oftentimes this is used as kind of a retention rate for non-subscription businesses. That's a practice that I would highly not recommend that people do. But this is defined to be, take everyone who made a purchase in the previous year, what proportion of them came back and made a purchase this year? So in the first year, this is kind of not defined because there weren't any customers who made purchases in year 0. But in year 1, we see that customer 1 had repeated. So they made a purchase in year 1, they came back and made a purchase in year 2. And correspondingly, in year 3, the repeat rate should be 50% because customers 1 and 2 made a purchase in the previous year, but only customer 2 made a purchase in year 3. So this would be not available, 100% and 50%. All right, we're almost there. Repeat bar proportion for orders. This is take all of the orders in the current period. What proportion of those orders came from repeat buyers? So maybe I'm going to put it back to you. What would be the repeat bar proportion for orders in year 1?
Not available. You don't know.
Well, so this one's kind of in reverse. That's definitely true for the repeat rate. But for RBPO, this is take all the orders from the current period and what proportion of them came from previous buyers. So customer 1, they made a purchase in year 1, but they are not a repeater. So that would be 0%. And then in year 2, we see 3 orders came from a first-time buyer, and 1 order came from a repeat buyer. So that would be I'm just going to give the answer over here, 25%.
Why is 25 not 50%? Because year 2 we have 1 and 2, and now 1 is repeated, so it's 50% of out of our total customers, isn't it?
You're actually one step ahead of me. So that's what we call the repeat buyer proportion for customers. So that's 50%.
Yeah.
So yeah, it depends on whether we're thinking about customers being repeaters or the orders coming from a repeater. So we see 3 orders came from non-repeaters, you know what I mean? And 1 order came from a repeater.
Yeah, you're right.
Yeah. So yeah, that's why I wanted to make that distinction clear.
Yeah.
Now the average buyer purchase frequency, this is take all the people who made orders during the period, what's the average number of purchases that they made? So in year 1, this would be, what would this be?
Average, oh, you mean the last one, the average order?
Yeah, it's the average number of purchases made by people who were buyers during the period.
For period 1, only 1.
Yes.
100%. That's all from period 1.
Yes, it would be 100%. Yeah, it would be 1. That just the average purchase frequency would be 1. In the second period, it would be 2, because essentially we had 1 person who bought 3 times, 1 person who bought once. So the average purchase frequency across those 2 buyers would be 2. And then the same in period 3, that we basically exclude customer 1 because that customer didn't make any purchases, but the average number of purchases made by purchasers is again 2.
So if 1 also purchased like 2 transactions, so the average will be 2.
That's right.
Okay.
Yeah, so another way of thinking of it is, in year 3, if customers 1, 2, and 3 had 0, 2, and 2 purchases, this would again be average purchase frequency of 2. So the reason we're focusing on these metrics is that there are a lot of companies that actually disclose them. So here's just a very small sample of the companies that disclose each of these metrics. So by far the most popular metric is the number of active users. There's many companies such as Amazon, Facebook, and Twitter that very regularly report these metrics. And just to kind of give a better sense for it, here's some actual data. So we see the number of active customers at Amazon, the repeat rate at QVC, and the repeat buyer proportion for orders at Wayfair. And just as a small hint, Wayfair is going to be one of the companies that we're going to do an analysis on in the next version of the paper. So very excited to share that once the results are finished. So kind of returning to that previous slide, we've got these 6 metrics. Now we know what they are. And one of the questions is, how many metrics do investors actually need to be able to make accurate forecasts of future orders? Because while we could kind of ask for firms to disclose all the possible metrics, and I'm sure we would do a wonderful job of being able to kind of pin down parameters if we were given all those metrics, all the firms aren't going to disclose every possible metric. So we want to be able to say, what's the minimum ask that we can ask of firms to still do a very good job of being able to pull out the parameters? And kind of the second question that follows from that is, what are the actual metrics that these investors are going to need? So the way that we answered this question is by performing a large-scale simulation analysis. So we created a whole bunch of different worlds, 64 worlds, some with heavy purchasing, some with very light purchasing, some with a lot of seasonality, some with very little seasonality, and so on and so forth. We generated 5 years of data. We then trained our model on those 5 years and then predicted what we would see over the next 6 years. And then we just tested how well our predictions held up relative to what we actually ended up seeing. So one way of thinking about the results is through the following chart. So here, I basically, across each of those 64 worlds, I compute what I call the mean absolute percentage error. This is a very standard metric, error metric. And I'm going to look at that as a function of the size of the collection. So again, I'm assuming that I've got some number of metrics, either frequency alone or active users alone. Those would be examples of size 1 collections, or every possible pair of metrics, every possible triplet, and so on and so forth, all the way up to assuming that we have access to all 6 of the metrics every period. So obviously, if we had all 6 metrics, we're going to do a great job of forecasting the future. That's exactly what we see with that rightmost point. The MAPE is on the order of 0.6%, which is very low. But we see kind of the most interesting thing is, first, if you were to give me any one metric, the MAPE is generally going to be quite poor. So it's going to be above 15% on average, which is it's just not good enough. But if you gave me the right set of 2 metrics, I could do an excellent job. So we see the error associated with kind of the best pairs of metrics is actually better than the error associated with kind of the worst set of 5 metrics. So this is really kind of a quality over quantity story. So the next thing I want to do is I want to kind of hone in on what are those good pairs of metrics. So I'm going to pull up all the possible pairs of metrics. I'm going to look at each of their MAPEs, and then I'm going to show on the bottom here what the actual combinations of metrics are. And so what we can see is kind of the elephant in the room is that if you give me frequency in conjunction with really any of the other metrics, I'm going to have a very low prediction error. So this is basically saying that frequency in a marginal sense is a very good metric, but you kind of need to have something else to be able to, kind of accurately pull out the parameters of the purchase model. So we see kind of the best metric, the best pair of metrics is frequency with active users. So what I'm going to do for that company that I had mentioned earlier, the e-commerce retailer, is assume that we only have access to just those 2 metrics. And the results are virtually the same as what we would have gotten had we access to all of the metrics. So let's return to that example. We got this e-commerce retailer. We have actual transaction log data from them from July 1st of 2010, or the beginning of Q3 2010, up through the end of 2016. We're going to aggregate that data, assume that we only have access to data that I'm going to show on the next slide. We're going to take that 5.5-year data set and split it into 2 periods. So just like with Dish that I showed before, I want to be able to show that I can make good predictions. So here I'm going to leave out kind of the final 1 year of our data set to kind of perform holdout validations on, and use that first 4.5 years to train our model. So this is, as I was mentioning, this is the actual data set. So whereas there's going to be millions of rows in the transaction log, we've simplified the data to something that I can fit on one slide of a PowerPoint presentation. This is very nice data compression. So for each quarter, we've got customer acquisitions, the number of active customers, average purchase frequency, median spend, and then because they're a public company, we've got quarterly revenues. And I could see analysts looking at a data set like this and saying, that's interesting. I could see this as being very useful information. So let's see how well we validate. I'm going to go process by process. So let's start with the acquisition process. So what we're seeing in the top panel here is what we expect and what we actually observe gross customers acquired to be. So we see some seasonality in the 4th quarter of each year, but in general, while we see some wiggles and jiggles about our predictions, the error tended to cancel itself out. And that's kind of made especially clear by the bottom panel over here, which is showing the cumulative customers acquired since the beginning of commercial operations. So that black dotted line represents the end of the calibration period, and that helps us see that both in sample and out of sample, we're still tracking quite well to what we actually observed. So next, let's turn to the repeat purchase process. First, we want to be able to make sure that we're getting the flow of transactions over time correctly. So what we're looking at here is just the total number of repeat purchases across all the customers quarter by quarter. And again, we're seeing we're doing a very commendable job of being able to capture all of those purchases, both in the calibration period and in the holdout period. And the reason this line is kind of going up during the calibration period and down during the holdout period is we're focusing our attention on customers who were acquired during the calibration period. Obviously, in the holdout period, then the company is no longer acquiring new customers, and as a result, the total number of purchases is going to begin to decline. This chart is essentially the cumulative sum version of that previous chart. So it's just showing the cumulative number of repeat purchases from the beginning of commercial operations up to different periods of time. And again, we can see excellent correspondence between actual and expected. This is a tougher one to hit. This is what I call the in-sample frequency distribution. So this is saying, imagine that I have the actual data, and imagine that I've got the parameters of my model. How many customers would I expect to make 0 repeat purchases? That is, I've acquired the customer and they're just not going to come back and make any more purchases. How many customers would I expect to make 1 repeat purchase, 2 repeat purchases, and so on and so forth, all the way up to kind of a 10 plus category? And again, this is very far from the data that we actually observe. We're only looking at ads, active customers, and average purchase frequency. So there's nothing from the data that directly would give us the frequency distribution, and yet we're doing a wonderful job of being able to infer it. And it's telling us some very interesting things about unit economics, kind of like Blue Apron. But here what we're seeing is most of the customers, about 70%, once they're acquired, they're going to never make any purchases after that. And so this business is very reliant on continuing to attract the customers that we see in that rightmost bin over there, just very active, very hardcore buyers. The final plot is perhaps the hardest one to hit. This is what we call the conditional expectations plot. So this is saying take every customer who made some number of repeat purchases in the calibration period. What is the actual average number of purchases that I expect in the holdout period? So obviously people who buy more in the calibration period, all else being equal, we would expect to buy more in the holdout period. But it's very hard to say exactly what that relationship is going to be. And we're seeing that essentially we're doing a very good job here of being able to forecast what that is. So again, this is something that we would only get to observe and validate on because we have access to the granular data.
The calibration period is what you showed before, the couple years before, right? Not just 1 quarter.
Yeah, it's actually 4.5 years. So it's everything from that 3rd quarter of 2010 up through 2015. Okay. All right, finally, there's the spend process. So again, we embrace heterogeneity. We want to make sure that we're doing a good job of getting the distribution of those spend amounts across the customers. And as you were saying, those spends tend to be very, very skewed. And that's exactly what we saw with this retailer. So the median spend, kind of that modal point, is on the order of about $150. We see there's a bunch of customers who every time they come back, we would expect them to spend north of $500, $600, $700, $800. So even though we don't quite get that modal amount perfect with our model, we're pretty close. We're seeing we're doing a good job of getting the general distribution. And I think this is perhaps the best that we can do with a very simple 3-parameter model. So we feel pretty good about the model. Let's run the machinery to turn this into a stock price estimate, or kind of an overall valuation estimate. So the way that we do that is we start with acquisitions. This is that same plot that I showed before of customer acquisitions quarter by quarter. And kind of like an accordion, let's shrink it all together to make room for a forecast period. So we're going to forecast what future acquisitions we're going to be for a very long period of time. Then using our purchase process, we're going to convert that into what we would expect total purchases to be over time. And then we're going to layer in the spend process to get what we would expect total revenues to be over time. So even though ads peak and then fall fairly early, and we see kind of the same thing happening with orders, revenue tends to grow, which is what we typically empirically see because of inflation and pricing power. The firm provided us with basically a number of assumptions that we should use to be able to get their corporate valuation estimate. So of what proportion of their costs are fixed versus variable, what their customer acquisition expense is, the weighted average cost of capital, and so on and so forth. And we end up with a valuation estimate of about $23 million. And while we don't have an actual public stock price to be able to compare this against, the firm was compelled enough that they've asked us to repeat the analysis 2 times. And I'm currently in the process of updating the numbers yet again. So yeah, I think that they really buy into this, and it's something that they could potentially present to their own investors to show how they're doing as a company. So what else can we learn about this model? Again, kind of recalling the example of Blue Apron. For Blue Apron, I didn't even provide a stock price estimate at all. The only thing that I provided were some insights into unit economics. And in some sense, I think insights into unit economics are more valuable, kind of a more valuable output of a model like this than even providing a stock price estimate. And so we learned some very interesting things about this e-commerce retailer as well. So the first thing is, if this company were to go into the market and acquire 100 customers right now, I would expect the average lifetime value of those customers to be approximately $76. But this number doesn't do justice to the extreme right skewness of what that CLV distribution is going to be. As Hui had said, we tend to see very strong skewness in spends, and that translates into a very strong skewness in lifetime value. So this is the actual CLV distribution that we predict. And what I'm pointing to with that black dotted vertical line is that average lifetime value. And what's interesting is if we were to kind of back this line up to the 0 point, we can see that a very large number of these customers, fully 68% of them, this company is not going to turn a profit on. And when we kind of presented this to the firm, they were saying that it could be that this is due to shipping issues, that you take all these first-time buyers, and if they have some sort of a logistical issue, which they had, because they don't have a strong preference for the firm, they say, I don't like this company. I'm never going to come back and make a purchase again. But as a result of that, most of the value is going to come from a very small number of people. So thinking about that 100 customers, just 3 of those 100 customers are going to generate fully 80% of the collective value of all 100 of them. So again, this kind of reiterates that point that for this firm to continue to be successful, it's going to need to be able to attract some very hardcore loyal customers, or they need to find a way to be able to reduce the number of unprofitable customers that they're acquiring. Another interesting thing that we can learn is about kind of the risk of the valuation. And we can think about risk in terms of how much of the value is coming from existing customers and how much is coming from customers that the firm hasn't even acquired yet. And there's something a bit more tangible, a little bit less risky, if most of the value were to come from customers that I've already seen and observed purchase behavior for some period of time. Because if I haven't even acquired the customers yet, I don't know if I'm going to acquire them. I don't know how valuable they're going to be. There's just a lot more uncertainty associated with yet to be acquired customer value. So for this company, we estimated that about 15% of the overall valuation of the firm is going to come from existing customers. And this is on the small side, but this is kind of what you'd expect from kind of a young, rapidly growing subsidiary of a growing business. And one of the ways that we can kind of better think about this is by thinking about the proportion of sales that are coming from existing customers versus yet to be acquired customers. So up until the end of the calibration period, by construction, 100% of the sales are going to come from existing customers. But just 3 years later, what would you predict the amount of revenues from existing customers to be? If you have any guesses.
5%.
Not that extreme. that'd be very extreme. But it is not too far off. So less than 25% of the revenues by that point will be coming from existing customers. fully 75% is going to be coming from newly acquired customers. But if we were to kind of extend that horizon even further, we see that green is starting to asymptote. And that's because the customers that remain are very hardcore loyal. And this is actually one of the very good things about this firm, that even though fully 68% of the customers are going to be kind of one and done, so to speak, they do a very good job of being able to acquire customers who really hang around for the long haul, like multiple years. So we were very impressed by that. And I've only seen one other company that's had customers that are this loyal. So it's really a testament to the brand. So kind of in summary, to wrap up, I've shown through a handful of examples how customer data can really improve company valuation estimates, but that more than that, it can kind of take us one level deeper. Instead of just thinking about revenues, we can think about customer acquisitions and how customer acquisitions flow through into orders and how orders flow through into sales. So it just really adds extra dimension to where that value is coming from. I've laid out methodologies for both subscription and non-subscription businesses and shown that essentially, even if we have external data, we can still do a very good job of being able to run a model like this. So I propose accurate models for both business types, and I've also shown what the most informative customer data would be for non-contractual firms. Again, holding aside gross customers acquired and median spend, I've shown that frequency in active users, and really frequency with almost any other metric, is going to do quite well. So as I kind of alluded to earlier, next up is a couple actual public company valuations, so we can do analyses much similar to the analysis that I had shown for Dish and for Blue Apron. So that's really all that I had for this talk. Here are links to the two papers. And if you had any other questions, I'd be more than happy to answer them now. And thank you very much for listening to me so late into the afternoon and evening.
Thank you, Dan. For the subscription and internal data case, so you have the survival data, like each month, how many new customer you get, and the term data for the customer from previous months. And for that revenue one, do you just multiply by revenue from each customer by the number of customers, or you have the revenue data actually?
Yeah, so actually, we only have quarterly acquisition and loss data, and we have quarterly revenue data. So that's the raw data that Dish Network provides. And so we kind of run this monthly model, but because we have this monthly model, we can aggregate it into what we would expect the quarterly numbers to be. But essentially the calibration is being performed off of first kind of quarterly observed customers acquired, customers lost, and then we kind of separately model average revenue per user, and that's essentially taking total revenues and dividing it by the ending customer count, roughly speaking. It's a little bit more complicated than that because we want to account for the fact that customers were acquired through the period and revenue was generated through the period, but that's mostly correct.
And do you have do you do any data pre-processing, like transforming the data?
None.
Or cleaning the data, missing value or whatever, you get the data?
Well, so the missing values, essentially, if you give me a set of hyperparameters, the parameters of the model, I can give you what I expect adds, losses, and ending customers to be over every period. And so the way that I dealt with that missing data at the beginning was essentially I just didn't, that didn't enter into the loss function. So all the data that I did get to observe, that's what I'm going to do this kind of matching process of expected versus actual on. But there was no additional data pre-processing at all. We don't want to do any funny business. And I'd say the other thing is the data had better be good. One of the good things is because this is publicly disclosed in SEC filings, if there really was a typo of some sort, that could get the company potentially into legal trouble. So Yeah.
And there's a variable contribution ratio. What is that?
Yeah, that's basically the proportion of expenses that are variable. So it's the proportion of expenses that will be a function of sales. So if I do $100 of sales and my contribution margin, my variable contribution margin is 50%, then my variable cost would be $50. If I had $200 of sales, then I'd expect $100 of variable cost. And really, that's to kind of distinguish it from the fixed costs that the company incurs. So the fixed costs, those will kind of remain the same as revenue grows, whereas the variable costs will kind of remain fixed as a proportion of sales.
And Moss, do you use any R package to analyze those?
It's a great question. There's nothing special that we use. I'd say the only thing that I've found kind of good use from is we want to be able to estimate the parameters well, and the kind of the objective function tends to be, I guess, not well behaved enough that kind of standard out of the box optimization software like BFGS doesn't tend to do well. So I use an evolutionary algorithm called DE-Optim to perform the estimation. But other than that, there's nothing special. We won't have an R package, I don't think, for the code that we use here, just because it tends to, every new company that you analyze, it tends to have some small differences or another that would make it difficult to release. But I do have Excel spreadsheets that I'd be very happy to share that show essentially how, if you were to give me a set of parameters, how that maps into what we expect all of the customer metrics to be. And that all happens on a spreadsheet.
Okay, can you share that link or the file to us?
I can share it one-on-one. I just want to make sure one of our co-authors is still in the process of kind of vetting the sheet.
Okay.
So yeah, until he kind of gives it the final thumb up, I'd be a little bit cautious about kind of publicly disclosing it. No pun intended.
Yeah. Okay. Thank you very much, Dan. It's a great presentation. Very clear.
Great. Well, yeah. Thank you again very much for having me.
Thank you.
All righty. Take care.